The look ahead with me, Fiona Cincotta, Senior Market Analyst at City Index. As we look ahead to the week beginning, bear with me, 12th of May. So as always, just asking you to take a look at the risk warning. Oh, just bear with me, sorry, bear with me, risk warning. I'm going to put myself on mute whilst you do that. Okay, so as always, we're just going to start by having a look at the economic calendar and also just a quick recap of what we've seen this week. So US equities are set to end the week flat. This is the S&P 500 that I'm just pulling up here. Basically, as the market digested sort of trade agreement, latest trade agreement with the US and the UK, alongside the Federal Reserve's decision to leave interest rates on hold for another meeting. The Federal Reserve has not cut rates so far in 2025. As we head into the weekend, attention will be on US and China officials as they have an ice-breaking meeting which is basically raising hopes of a potential easing of trade tensions. So this is the S&P 500. As we can see, it's sort of been trading relatively within that familiar range, just really consolidating below that sort of 5,700 level, which is the level that we also saw back in November as the November low. Haven't managed to push above that yet. We've obviously seen an incredible recovery from the April lows, but haven't really managed to get over that 200 SMA yet, which is at 757.50. That's what we're watching for next week. I think, you know, as far as trade developments are going to remain very much in focus and a key driver. The markets have been jumping from headline to headline, finding support from news that announces trade decisions, sort of optimism surrounding trade deals. Obviously, any more news on tariffs, concerns over pharmaceuticals has been one that's been very much in focus that Trump said would be coming within the coming weeks. So that's one to be watching out for. Any new trade tariff announcements could obviously have a negative impact on the market. Other things that I've been watching out for this last week, the German DAX rose to a record high today, just topping the previous record high. In Germany, we saw that the German Chancellor Friedrich Merz was elected after a second vote. That was a little bit of concern first thing on Tuesday, but he did actually win the election on the second vote. So that's encouraging. That's obviously boosted support for the DAX. As well, the DAX, as we know, has been benefiting from that sort of sell America trade that we saw over the last few after the announcement of the trade tariffs. As we can see, you know, the DAX is back up at record highs, and when we contrast that with the S&P, which is still down at that 5,700 level, there's obviously quite a difference there. This week, we also saw the Bank of England announce interest rate decision. They cut interest rates by 25 basis points to 4.25%. And we also had that trade announcement come as well from Trump. It's not actually a trade deal, but it's a framework, if you like, that has some encouraging signs. Obviously, since Brexit, the UK has been keen to get a trade deal with America. Certain particular areas such as industrials, chemicals, agriculture, cars, they're the areas which are set to benefit. Aluminium and steel also had the trade tariffs removed. Cars have had tariffs set at 10%, and that's down from the 27.5% that was initially feared. So that's what's been going on. The pound did actually fall yesterday, despite a hawkish vote from the Bank of England, and that was basically because of the strength of the US dollar, which rebounded on the back of this trade deal hopes. So just as far as what we're going to be watching out for next week, as I said, trade headlines are likely to trump most other data releases, not potentially not US inflation. But so let's just kick off with that one actually. So US inflation. And basically it called for a second straight month in March with the headline CPI easing to 2.4% from 2.8% previously. And that marked its lowest level since September 2024. Now, core CPI also eased to 2.8%, down from 3.1%, marking its lowest level since March 2021. But despite the signs that inflation was cooling, President Trump's plans towards global trade tariffs and that uncertainty could actually stall this disinflation process that we're seeing. Obviously, we had the Federal Reserve meeting and Jerome Powell warned over the prospect of higher inflation and the risks to inflation in the wake of Trump's trade tariffs. Now, the market's currently pricing in around 25 basis points worth of cuts in July, and with three cuts across the rest of the year. That's a little bit more dovish than the Federal Reserve, which is projecting 2 cuts. So expectations are that CPI will hold steady at 2.4%. On a monthly basis, it's expected to rise 0.3% after falling 0.1% in March. Any sense of hotter than expected inflation could actually unnerve the markets. And I think let's just pull up the US dollar here. You know, we have seen a recovery from that low. It's back over that 100 level, which is pretty key. Next level that we'll be watching for is around the 101.80, 102 level. That's going to be the next level for buyers to look for. If we get hotter than expected inflation, maybe we will see the US dollar rising. It does mean that potentially the Federal Reserve will push back interest rates sooner to wait and see what the impact of Trump's tariffs will be on already hot inflation. If that is the case, as far as we've looked at the US S&P, let's just take a look at the Dow Jones. Dow Jones also just there at a sort of pretty key level again. We're looking at sort of that November low, just stuck below there at the 41,500. Has recovered, but again, you know, comparing it to the DAX, we're nowhere near those record highs. The recovery has stalled halfway. So if we get hotter than expected inflation, then I think we could potentially see stocks fall lower on those concerns that the Fed might focus its dual mandate on the hotter price, on the inflation area. It's also worth remembering that Federal Reserve Chair Jerome Powell also warned over the impact of Trump's tariffs potentially on unemployment, which could also tick higher. So that is US inflation, likely to be the key focus for next week. US retail sales are also there, and Federal Reserve Chair Jerome Powell speaking. So again, it's going to be very much a focus on what sort of Powell is saying with regards to Trump and the trade tariffs. It'll be interesting to see if he adds anything new after this week's Federal Reserve meeting. So obviously it depends on what developments there have been by then, but obviously the market does tend to hang on what Federal Reserve Chair Jerome Powell says quite closely. So this is gold as well. I mean, obviously with the inflationary outlook, Federal Reserve, whether they're going to be cutting rates or not, this is all very much in focus. We're still, I mean, we did have that increase towards the 3,400, 34.35 was where we got to just last week, but we've seen a fall away from that this week, and that was sort of on the optimism surrounding the trade deals. Obviously, gold has rallied hard on expectations or on safe haven flows, should I say, you know, on concerns over what Trump's trade tariffs means for global growth and looking for safety to protect portfolios. But actually, we've seen it fall away from those highs. The uptrend, though, is still intact. So, you know, despite the fact that we have seen it fall away, it's not actually showing signs of any reversal yet. It actually did fall away from there, and it's just finding support on that rising trend line, near-term rising trend line support that we've seen. So levels to be watching out for. This seems to be holding. 3,300 seems to be holding for now. If we get a break below 3,300, then I'll be looking at 3,200 as the next level on the downside, and that would create below there. We'd be taking out the lower low of May, creating a fresh low. And then obviously we've got this rising trend line, which dates back to the start of the year. So if we get a break below around the 3,100, then that would obviously be taking out that as well. Hotter than expected inflation could potentially do that. Upbeat, encouraging developments in trade talks could also bring gold prices lower. There we go. So other things to be watching out for. Let's also just take a look at its what have we got on here? We've got, going back up, GDP. We have the GDP for Japan. Now, Japan supposedly is also on the list, Trump's list of countries where he's looking to get trade deals done sooner rather than later. Other countries obviously was the UK, India, and Japan are all on this list. Now, obviously, we've got Japan GDP coming. It's expected to contract. We're expecting a contraction of 0.2% in Q1 of this year, and that comes after 2.2% growth in Q4 of last year, marking the first contraction since the start of 2024, and is expected to be basically driven by a 0.6% drag from net exporters, and that compares to a 0.7% contribution in the previous quarter. So, I mean, this is basically reflecting a surge in imports outpacing exports as firms front-loaded shipments ahead of expected US tariffs. So, I mean, this is just another example. We've seen Germany data. We've seen so many examples of how these expectations of tariffs have created erratic data points recently. Obviously, US GDP was just a prime example of that, with that contraction of 0.3%. But that was actually just a result of increased imports ahead of all these tariffs. But it's also worth bearing in mind that last week the Bank of Japan held interest rates unchanged but lowered its growth outlook owing to the uncertainty surrounding global trade. A weak GDP print could then reinforce what Ueda said and the Bank of Japan. Now, interestingly, we have seen the yen weaken from the low there of the 140 that we reached. Just bear with me. Yeah, so that was the 140 low that we reached just at the end of April. We've seen a recovery in the US dollar since then as it's pushed over that 100 mark, which has also seen the Japanese yen break out of this downward channel that it's been trading in since the start of the year. Now, to confirm the breakout, we'll be looking for a rise above this 146.20 level. That's sort of the high that we saw this week, needing a rise above that. That's also the 50 SMA to push on back up towards the 148.50 level. That's as far as the upside is concerned. So if we get weaker than expected yen, Japanese GDP, or if we find upbeat data regarding upbeat news regarding trade developments, and that could also weaken the safe haven yen, which has been one of the currencies which has really benefited from the weakness in the US dollar and those safe haven flows that we saw across April. If we do get potentially disappointing trade developments between US and China, particularly over the weekend, that could actually serve to strengthen the yen ahead of the data release. Watch out on the downside. We've got the support of the 145, which we're just sort of coming to now, and that just is also the upper band of that falling channel. So if we get a break below that, then we'll back into the falling channel, and that sort of brings naturally the 143.60 50 level back into focus. It's going to take a move below 142.40 to get a lower low in. So what else are we going to be watching out for? We've also got, just going to go back up to the start, so we've also got UK data. We've got UK jobs data, which is going to be in focus. So far, the UK labour market has been holding up. Obviously, we've seen wage growth has been stronger than what the Bank of England would like to assign to inflation at the 2% target level. However, we have had sort of, concerns that potentially the trade tariffs that have been set by Trump, because although there is this trade agreement, they haven't managed to remove the 10% universal tariffs on most products. So, that's obviously going to have an impact. Obviously, we've also got the impact from the increased tax burden from the Labour government's budget back in October, which is also weighing on employers. So that data could be quite telling, although the data actually still only relates to March. Employment count is to April, but the unemployment is still March, which is still quite early on, because actually the increased burden didn't take effect till April. So this will still be companies preparing for the increased burden if we do see changes in employment levels. So if we get some weak data, then I think that potentially could see GBP USD have a retest of that 132 level, which it hit yesterday. That was obviously as a result of US dollar strength. As a result of the trade deal that I mentioned, the pound did actually rise against the euro, for example, yesterday. But yeah, so if we get weaker than expected jobs data, look out for that 132 level. If we get a break below that, then that potentially could be opening the door back towards 131 and on towards 130, the round key psychological level. As far as the RSI is concerned, we are seeing that momentum slowing from where it has been, and that's as we're just testing that rising channel, the lower band of the rising channel. So they're the levels we're watching on the downside. On the upside, if we get upbeat labour data, upbeat jobs data, then that could be quite encouraging. Look out for 133.50 and the 134 levels on the upside in order to take a rise above 134.50, which would create a higher high. Now, in addition to the jobs data, we also have UK GDP data. Interesting, UK GDP has actually been a little bit stronger than expected. We saw that solid 0.6% GDP gain in Q1, so the market's going to be watching closely to see whether that will be confirmed. We'll also have the monthly GDP figures coming through. The Bank of England did actually increase its growth outlook for 2025, which I thought was interesting given the concerns over the trade tariffs, but it did lower its 2026 growth forecast, seeing the hit obviously come through next year and in years following. Just whilst we're talking all things GDP, let's just take a quick look at what's going on with the FTSE. FTSE has recovered, not as much as the DAX, has recovered from those lows, but is struggling to push above that sort of 8,700 level. We've got that long upper wick there, and now we're just seeing this sort of like steady state of play. I mean, the RSI still is over 40, so you know there is still encouraging signs, but and we're still above the 200 and the 50 and 100 SMAs, but that long lower wick suggests that there was little demand at those upper levels. Interestingly, there are certain companies that performed particularly well this week, owing to Trump's announcement. Rolls-Royce being one of them. They were up over 3%. Yesterday on the back of the news, because they were going to be able to export to the US without levies. So that was an encouraging. Other companies such as Melrose, so the industrials are the ones that performed particularly well. Obviously, there's the China trade talks. The UK FTSE 100 is particularly heavyweight with miners and oils. So if there are sort of encouraging signs, that could be the boost that the FTSE needs to push above that 8,700 if those trade talks go particularly well. Just whilst we're talking about China trade talks, etc., definitely worth taking a look at what's going on in the oil prices, because we've actually seen a recovery from that multi-year low that we saw at the 55 level. Look at that long lower wick, though, suggests that there was little selling demand at those lower levels. We've seen a recovery above the 60 level. Next one we'll be looking out for is the 62 level. That was the low that was sort of came into in August 2021. That's some levels to be watching out for. But really, you know, if we're going to get sort of anywhere sensible with this, we need a rise above 65. That's the low that we saw back in September, and also it's the low that we saw in March. That's the level that buyers are going to be looking out for. If we get encouraging news, I said, surrounding trade data, that might be trade developments, that might be enough to push it up there. It doesn't look like we're going to be getting a recovery of that low, but still with OPEC plus increasing output, there potentially could be concerns over oversupply still lurking, which could have a negative impact on the price. Just as far as Eurozone, it's quite a quiet week as far as Eurozone is concerned. We've got GDP data. GDP was relatively strong in Q1, which will be the market will be looking to see whether that is confirmed. Interestingly, we're just seeing it as well, similar to the sterling US dollar, we're just seeing it test the lower bounds of that rising channel that's been in place since the start of the year, after a long period of consolidation below that 115 level. Sellers, if we get a slightly downward revision, any concerns regarding or news regarding trade developments, particularly with the Eurozone, we know that Europe is not Trump's favorite trading region. It's because of the large deficit they have. Break below 112 could come if we get disappointing trade developments from the European Union. On the upside, this is going to be the level to be watching. If we get any dollar weakness, watch out for a rise above the 112.80, and that would bring us back up to the 114 level to keep in focus. If we get weakness in the US dollar, we might see, or encouraging developments as far as trade is concerned, then we might see the euro push back up there. We've already had a quick brief look at the DAX. I'm just suggesting that we have a look at it again. We're trading at all-time highs. We're not in our overbought or oversold territory, overbought territory. So there is a potential for further gains there. Germany obviously has benefited from the relocation out of US, and obviously with the new chancellor, hopes on spending, etc. That's been and the ECB expected to keep cutting interest rates. That's been very supportive of the German index. So they are the main ones to be watching out for. We've also got the inflation for Wednesday. On Wednesday, that's a repeat. It's not the preliminary reading, so it doesn't tend to be as market moving. And then finally, we've also got US earnings. Earnings are going to be very much, we're seeing earnings season starting to wind down in the US. We've got the focus sort of shifting towards the Chinese companies that are listed on the NASDAQ, such as Alibaba, JD.com, and Tencent. And that could offer some insight into the strength of the Chinese consumer demand. That's what we're going to be watching for, particularly how it was holding up ahead of these trade tariff announcements. We know that Beijing has been keen to support Chinese consumer demand, which had been relatively weak, and also the growth prospects surrounding AI. These companies might offer us some growth, some clues surrounding that. As far as other companies also reporting, there's Walmart, which is going to give us some insight into how the consumers were holding up in the US ahead of trade developments. This is the NASDAQ. Again, similar chart to what we've been seeing with the S&P 500 and the Wall Street. It's really picked up strongly from that low that we saw back in 1600, 325, recovery above some key levels. What we're testing here now is the 200 SMA. RSI is above 50, so you know that potentially could be bringing some strong momentum. We've risen above the 20,000 psychological level. Need to get above this 200 SMA, which is also around the 20,300 level, in order to extend this rally. That level is also the high that we saw on the 26th of March. If we can get above that, we're getting a higher high. It's changing the structure of this chart as far as that steep fall is concerned, and it opens the door to 21,000. That's what the market's going to be looking for. Obviously, any developments as well, so surrounding the chip export curbs, which we saw sort of, our expectations are that they're going to be eased slightly. A Biden era regulation could be eased slightly. That's obviously helped chip stocks across the past week. Any more sense of easing curbs will on tech stocks could help push the NASDAQ back up to that 21,000. But if we get disappointing trade talk news over the weekend, if we get stronger than expected US inflation, then that could mean that this 200 SMA proves too much of a resistance for the price to get back over. Looking back down, 20,000 is the immediate low, and then we've got down here, we've got that support zone around the 19,000, 19,300 level. Listen, I hope you've liked everything that we've discussed here. If you do, then please do give this video a like, and I will see you next week.